Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the Producer Price Index. In point number 3, we'll take a look at the Consumer Price Index. And in point number 4, we'll talk about the index of consumer sentiment. So with that, let's hop right in.
And now on to point number 1, the market recap.
First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 2.4% growth as of April 9th. Which is slightly up from last week's negative 2.8%. Next, each week, we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims rose by 4,000 claims, ending at 223,000, while continuing claims fell to 1.85 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement again in the 30-year and 15-year mortgage rates, ending at 6.62% and 5.82% respectively. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose from a negative 40.16% last week to a negative 30.42% this week. Investors are still continuing to feel quite bearish with the current market, and we'll discuss investor sentiment in more detail later on in the video. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Now, we saw this in real time with the roller coaster that we saw this past week with the market. The VIX values above 30 are typically linked to large volatility, resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 37.56, highlighting very high uncertainty and fear in the market. We hit a new high on the VIX this week, hitting 52.33, which is the highest value we've seen since the pandemic. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 39.8% probability of a 0.25% decrease and a 60.2% probability of no decrease in May. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 5.97%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 2.78%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 7.33%. The biggest mover this week was international stocks, and we can finally all exhale a little bit after hearing the 90-day pause on tariffs by the Trump administration. Now, it remains to be seen how the negotiations play out over the next 90 days. We saw some movement and concessions over this past weekend with the Trump administration excluding some products from the overall tariffs from China. Now, as mentioned, more to come on this, and the actual impact is still a big unknown. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On point number 2, the Producer Price Index. News data released in March showed that U.S. wholesale prices fell by 0.4%, a better than expected result, and the annual rate slowed to 2.7% from 3.2%. This decline in the Producer Price Index, or the PPI, indicated that inflationary pressures weren't necessarily building before reaching consumers. The drop was largely attributed to a 0.9% tumble in goods prices, with gasoline prices notably falling by 11.1%. Final demand services also saw deflation, dropping by 0.2%. Excluding food and energy, core PPI also dropped by 0.1%. This report was seen by some as a potential indication that efforts to dampen demand and curb inflation were working. This encouraging PPI report followed a similarly positive Consumer Price Index report, or CPI report. We'll talk about that next. While some economists noted that inflation was already on a cooling course before the significant uncertainty introduced by President Trump's aggressive trade policies and financial market turmoil. While the PPI serves as a potential early indicator for retail level inflation, the impact of newly implemented and proposed tariffs on Chinese goods, steel, and aluminum was beginning to be scrutinized by the PPI data. Notably, wholesale iron and steel mill prices jumped by 7.1% in March, suggesting that the steel and aluminum tariffs were starting to have effect. Despite the positive inflation data for March, economists expressed concerns about potential for higher prices for businesses and consumers due to the sharp escalation in America's effective tariff rate. There were fears that the trade policy trade policy changes could disrupt the global economy and possibly trigger a recession. The drop in overall PPI was partially attributed to the broader concerns about a potential global economic slowdown. While some economists cautioned that the good inflation numbers might be overshadowed by the pressures expected to build as tariffs fully go into effect. They anticipated seeing more tariff-related price pressures reflected on future PPI data as Trump's tariff regime continues to escalate throughout April. On to point number 3, the Consumer Price Index. The March CPI report indicated a cooling of inflation, with the Consumer Price Index unexpectedly falling by 0.1% month over month, the first monthly decline in nearly 5 years. This was lower than the 0.1% increase economists had expected. On a year-over-year basis, the CPI increased by 2.4%, also below the anticipated 2.6% rise. Core CPI, which excludes volatile food and energy prices, rose by a smaller than expected 0.1% month over month and a 2.8% year-over-year. This decline in overall CPI was partially driven by a drop in gasoline prices, as well as lower costs for used motor vehicles, airline tickets, and hotel rooms. However, food prices did see a 0.4% increase in March. Despite the positive inflation data for March, it's important to emphasize that these figures likely do not reflect the impact of President Trump's tariffs on imported goods, particularly from China, as well as he levies on steel and aluminum. As well as the levies on steel and aluminum. The CPI data was considered by some as potentially quote-unquote dated because it might have only captured a fraction of the initial tariff wave. While the March inflation reading might have provided the Federal Reserve some quote-unquote breathing room, there was a prevailing sentiment that the escalating trade war and tariffs could lead to higher prices for businesses and consumers in the future. Concerns were raised that these trade policies could shift the focus from jobs to inflation for the Federal Reserve. Many economists have expressed uncertainty about the extent at which the softer inflation in March would persist in the face of increasing tariffs. Some anticipated that weakening demand could partially offset the price pressures from higher costs due to tariffs. However, there were fears that the significant increase in the effective tariff rate could disrupt the global economy and potentially heighten recession fears. While the March CPI showed little evidence of China tariffs affecting goods costs yet, the potential for tariff-driven inflation to surge remained a significant concern, overshadowing the positive inflation report. And finally, point number 4, consumer sentiment. U.S. consumer sentiment experienced a significant plunge in early April, marking the 4th consecutive monthly decline, according to the University of Michigan survey. This sharp decline of 11% from March reflected a pervasive and unanimous decrease across various demographic and political affiliations. The primary driver behind this pessimism were growing worries about President Trump's trade policies and escalating tariffs, which had seemingly reversed the economic optimism following the presidential election. Consequently, consumers, including Republicans, expressed fears of skyrocketing inflation and weakening economy, expectations that economists suggested could be self-fulfilling. The survey highlighted deteriorations in expectations for business conditions, business financing, personal finances, incomes, inflation, and labor markets, and rising recession risks. This decline in consumer sentiment stands in contrast to some key indicators we've talked about from March, such as the Consumer Price Index and the PPI. Similarly, weekly unemployment filings remained low, and the economy added a healthy number of jobs in March. However, the Michigan survey data collected before Trump's announced 90-day freeze on reciprocal tariffs might not have captured any of the potential relief from these later developments or ongoing trade negotiations. The survey revealed that year-ahead inflation expectations surged to 6.7% in April, which is the highest reading since 1981, indicating a growing worry about future price increases. Many economists have expressed uncertainty about whether the key indicators that we've talked about would continue to remain solid in the face of declining consumer confidence and escalating tariffs. Concerns were raised about a potential pullback in consumer spending, which accounts for a significant portion of the U.S. economy. Some economists warned that tariffs on components, raw materials, and retaliatory tariffs from other nations could amplify the negative economic impact. The historical context of the average effective tariff rate reaching its highest level since 1907, exceeding the Smoot-Hawley era, also fueled worries about a potential economic downturn. While some hoped that the pause in tariffs increases might provide some relief, the underlying anxieties about the long-term effects of the trade policies on inflation and economic growth remain prevalent. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners all across our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.